Right now, technical traders are deadlocked in this $500,000 options stalemate over a company that literally prints $9 billion in free cash every year.
Yeah, half the market is betting the stock will absolutely soar, and the other half is, well, putting their money on a sudden collapse.
It's wild. Welcome to the invisible financial war that's basically dictating your next vacation. Today, the expectation of just a simple, relaxing trip is actually powered by a staggeringly complex, data-driven machine.
Right. You click a button for a beach house and you are immediately interacting with, algorithm pricing, global regulatory battles, and billions of dollars in Wall Street speculation.
Exactly. It's the ultimate contrast. That serene vacation photo on your feed is generated by one of the most intensely competitive corporate ecosystems on the planet,
And the strategies these companies are using to capture your travel budget have completely diverged.
which is exactly our mission for you today. Welcome to your custom-tailored deep dive. We are going to thoroughly unpack the 2026 global travel ecosystem by putting two absolute heavyweights head-to-head.
Airbnb and Booking Holdings.
You guessed it. And we are pulling from a massive stack of data to do this. We've got Trafa's financial models, Simply Wall-Saying growth projections, Booking's Q4 2025 investor presentation.
Plus, live 2026 options flow data and the latest news on international regulatory battles.
Yeah, we are cutting right through the noise to deliver the so what of these travel giants for you. So let's jump right in.
Let's start by looking at Airbnb. I mean, everyone knows the name, but the sources show they are quietly going through a massive evolution.
Right.
They aren't just a places to stay app anymore. They are actively pivoting to become a comprehensive lifestyle platform.
Okay, let's unpack this because changing the fundamental identity of a massive tech company is a huge risk.
It really is.
The data highlights over 535 recent feature upgrades. That tells me they aren't just moving the booking button around, to see what gets more clicks.
No, they're completely rewriting the user experience.
Yeah, they've launched this new co-host network, and they are rolling out new social features specifically for Airbnb experiences.
What's fascinating here is the underlying psychology of that shift. By connecting guests with local hosts before, during, and after their trips, they are creating a sticky ecosystem.
A sticky ecosystem.
Yeah, from a business perspective, the goal is retention. If you are chatting with other travelers and booking local pasta-making classes through the app, your vacation identity becomes tied to Airbnb.
Oh, I see.
You are far less likely to open up a competitor's app to compare prices for your next trip.
So they are essentially trying to move from being your digital landlord to being your full-blown vacation concierge.
Right.
They want to own the entire memory of the trip.
Exactly, not just the bed you sleep in.
And I have to imagine that concierge model is lucrative because the financial engine powering this is formidable. Looking at the Trefis data, Airbnb has reached $12.24 billion in last 12 months revenue.
Also known as LTM revenue, yeah.
Right, maintaining a solid 10% growth rate.
Yeah.
$12 billion for a company that essentially owns zero physical real estate.
That asset-light model is the holy grail of modern tech, and it's why their profitability metrics are just staggering.
That's your numbers.
They're pulling in $2.54 billion in operating income, which translates to a 21% operating margin.
Wow.
But the number that really jumps off the page is their cash generation. $4.64 billion in free cash flow.
Let's make sure we define that for a second. Free cash flow isn't just revenue. That is the actual cash left over in the bank account after they've paid all their employees, kept the servers running, and paid the bills.
Right, it's the real money.
Generating $4.5 billion in pure, uncommitted cash gives a company an incredible amount of leverage.
It gives them invincibility in certain market conditions. When we look at their balance sheet, their net debt-to-equity ratio is negative 12%.
Wait, negative, meaning they aren't just debt-free, they are effectively acting as their own bank.
Precisely. If a global credit freeze happens tomorrow and interest rates skyrocket, their competitors will be starving for expensive loans just to survive.
While Airbnb could just live off its own massive pantry of cash.
Exactly. They are heavily insulated against credit crunches. But that financial fortress doesn't mean the stock is a simple bet. This is where the valuation metrics in the Trefis data present a really interesting puzzle.
Yeah, I noticed that contradiction in the data too. Trefis labels Airbnb as a dip buy based on that massive free cash flow yield, which is sitting at a very attractive 6.1%.
Right.
But then you look right below that, and its price-to-sales ratio is 6.2x.
Right.
For an investor, paying over 6 times the company's total sales to buy the stock seems incredibly expensive.
Yeah.
How does the market justify that premium?
Well, to understand that, we have to look at the Simply Wallsaint growth projections. The market isn't pricing Airbnb based on what it is today.
What are they pricing it on?
It's pricing the stock based on the velocity of its future profit engine. Analysts are forecasting a 27% return on equity in 3 years, alongside an expected 15.6% annual earnings per share growth.
Let's break down that return on equity metric, because a 27% ROE sounds massive.
It is.
That essentially means for every dollar of shareholder money they hold, they are expected to generate 27 cents of pure profit every single year. It's a measure of how highly efficient their financial engine is.
Exactly. Investors are willing to pay that expensive 6.2x entry price today because they believe the sheer speed and efficiency of Airbnb's profit growth will quickly make up for it.
Makes sense for growth investors.
Right. For growth investors, that premium is completely justified. But if we connect this to the bigger picture, that hyper-efficient financial machine is facing severe real-world friction.
And this is where the digital platform crashes headfirst into local city politics. The sources specifically highlight escalating global regulatory pressure.
It's getting intense.
We're looking at a complete short-term rental ban in Barcelona and incredibly strict new rules choking the market in Amsterdam.
We have to emphasize why this is such an existential threat. This is not just a standard corporate PR headache. These regulations directly threaten Airbnb's host supply.
Oh, absolutely.
The entire multi-billion-dollar valuation we just discussed relies entirely on having a massive, diverse inventory of unique homes.
Because their product is the supply. If major global tourist hubs ban short-term rentals, Airbnb doesn't just lose a percentage of revenue.
Their inventory literally goes to zero in those markets.
Right. No supply, no platform. It's a localized death sentence for the app.
And the risks aren't just external. The Trefis report points out internal financial vulnerabilities too.
Like what?
Currently, 13% of Airbnb's revenue goes towards share-based compensation. Yeah, they are paying their employees with a massive amount of stock, which quietly dilutes the value of the shares held by everyday investors. Furthermore, there has been notable insider selling recently, including a co-founder unloading $22 million worth of stock.
Look, whenever a founder cashes out $22 million, the market definitely raises an eyebrow. But the recent news shows Airbnb is fighting back aggressively against both of these problems.
They are.
To counteract that stock dilution we just talked about, they announced a massive $6 billion share buyback program. And to fight the supply problem, they are throwing pure cash at new hosts.
Offering $750 incentives, right?
Exactly, to get properties listed ahead of the FIFA World Cup 2026.
It is a fascinating push and pull dynamic. They are leveraging their massive cash reserves to artificially buy loyalty and secure physical supply. But the future predictions remain quite mixed.
How so?
While earnings are forecasted to grow 13.9% annually, analysts recently decreased their price target down to $134.
Dropping the price target seems like a reaction to those weak expected trends through the first half of 2025 that the sources cited.
Yeah, exactly.
Even though Airbnb is recovering from that slump as we sit here in early 2026, it proves that even a highly profitable lifestyle platform is vulnerable to shifting consumer travel habits and aggressive local mayors.
It highlights the core vulnerability of their model. Airbnb is a single dominant brand name fighting city regulators block by block.
Which perfectly sets up the contrast with our second stock, because their strategy is completely different. But before we pivot to the absolute behemoth that is Booking Holdings, I want to take a quick second to speak directly to you listening.
Please do.
If you are getting value out of dissecting these financial models and uncovering the hidden mechanics of the market with us, make sure to hit subscribe, like, or drop a comment on the YouTube channel. It literally tells the algorithm to let us keep building these massive, data-heavy deep dives for you.
The interaction genuinely makes a huge difference in allowing us to dive this deep into the data.
All right, let's shift gears. So Airbnb is spending billions trying to become your cool local concierge, fighting regulatory battles in the trenches.
Right.
But what if the future of travel isn't about curating localized vibes? What if it's just about owning the underlying plumbing of the internet?
That brings us to Booking Holdings.
Yes, it does.
Yeah.
They don't rely on a single brand. They rely on a massive, diversified portfolio to weather any storm.
The scale of Booking Holdings is hard to overstate. And they thrive on the illusion of choice. If you've booked a trip recently, you've likely used them without even realizing it.
Oh, definitely.
You might think you were shopping around for the best deal, but their portfolio includes Booking.com, Priceline, Agoda, Kayak, and even OpenTable for your restaurant reservations.
So whether you are trying to find a cheap flight on Kayak or bidding on a hotel on Priceline, the money is ultimately flowing back into the exact same corporate treasury.
Exactly.
And their strategic vision, according to their Q4 investor presentation, is to formalize this dominance through something they call the connected trip.
The connected trip is about completely eliminating the friction of travel planning. They want you to book your flight, your hotel, your rental car, and your dinner all within their unified corporate ecosystem.
They want to be an inescapable digital toll booth.
That is the perfect way to put it.
I have to play devil's advocate here, though. Do consumers actually want a connected trip? I mean, isn't the whole point of the internet that we like to hunt around?
Yeah, people love to browse.
Right. We open a dozen different tabs, compare prices, and feel like we scored a massive deal. Do we really want to be locked into one walled garden for our entire vacation?
It's a great question, and there's definitely a segment of travelers who treat deal hunting like a competitive sport. But Booking is betting billions that the average consumer ultimately values convenience over saving $5.
I bet you'll get lazy.
Pretty much. They are betting that if they can make the interface seamless enough, you won't bother opening that second or third tab. And when we look at how this agency model translates to their bottom line, that bet is paying off in a staggering way.
Let's hear the numbers. If Airbnb is a $12 billion business, how does an invisible internet toll booth compare?
Booking brought in $26.9 billion in last 12 months revenue.
Wait, that is more than double Airbnb's entire revenue stream.
More than double, and it is growing at a massive 16% year over year.
That's insane.
Because they act as a low overhead toll booth, taking a commission on every transaction without having to manage physical properties or deal with local city councils. They generated an incredible $9.28 billion in operating income.
Wow.
And their free cash flow sits at $9.08 billion.
$9 billion in free cash flow. Every time you pay those hidden back-end fees on an aggregator site, you are feeding this machine. How do they manage their debt with that kind of scale?
It's masterfully managed. They hold $16.1 billion in cash and investments, which almost perfectly balances their $16.3 billion in gross debt.
So it zeroes out.
Basically. Because of this massive cash generation and perfectly balanced ledger, they've earned solid A3 and A- investment-grade credit ratings. It's a highly mature, heavily optimized logistics operation.
So we have this mature logistics giant pulling in double the revenue of Airbnb. Let's look at the valuation, because this is where the contrast gets really stark.
It really does.
Airbnb had that highly expensive price-to-sales multiple because of its growth story. But Booking has a forward PE, a price-to-earnings ratio predicting future performance, of just 13.68. Analysts consider that to be significantly undervalued compared to its peers in the tech and travel sectors.
And that perceived undervaluation is backed up by some incredibly robust health metrics. In the Guru-focused data, we see a metric called the Altman Z-score.
I was looking at that in the sources. What exactly is an Altman Z-score for the non-accountants listening?
Think of it as the ultimate corporate stress test. It's a historical formula that combines multiple income and balance sheet values to measure the financial health of a company and mathematically predict the likelihood of bankruptcy.
Okay, so a higher score is better.
Generally, any score above 3.0 indicates a company is in the safe zone. Booking Holdings has an Altman Z-score of 6.36 or 6.40 depending on the exact daily inputs, which is right near the sector median.
That's solid.
It essentially tells investors that this company has ironclad financial health and virtually zero bankruptcy risk.
Here's where it gets really interesting, though. We have the live March 13, 2026 True Sentiment Analysis Options data. This looks at what the big money on Wall Street is actually doing right now.
The real bets.
Exactly. The stock is currently trading around $4,241 to $4,287. And the options flow, the actual financial bets placed on whether the stock will go up or down, is almost perfectly divided.
It's incredibly tight, almost to the dollar.
Wait, so the sources show 48.5% calls, which are bets the stock will rise, totaling about $421,000 in volume, versus 51.5% puts, which are bets the stock will fall, totaling about $447,000. That is a total stalemate.
This raises an important question. Why is the market so paralyzed on a company printing $9 billion in free cash flow? You have an objectively healthy company, yet half of the smart money is betting the stock will fall.
It doesn't make any sense.
It almost defies logic until you look at the technical trading levels. This neutral to cautious stance in the options flow, combined with the fact that the stock is currently trading below its 50-day simple moving average of $4,695, shows real market indecision.
Technical traders are holding their breath.
Exactly. They're waiting for a definitive breakout, despite fundamental analysts setting massive price targets as high as $5,796, which would represent a 35% upside.
So you have a clash between the technical reality of the stock dropping below support levels in the short term and the long-term fundamentals looking incredibly strong. And we also have to factor in the macro environment.
We do.
The historical options data source specifically cites tariff fears hitting travel as a potential macroeconomic headwind that is keeping these Wall Street traders cautious.
And we need to pause here for a mandatory neutrality disclaimer. We are strictly reporting the sentiments of market traders as presented in the source data. We are simply relaying what the options market is reacting to and pricing in.
Absolutely. We take zero political stance on tariffs, trade policies, or international relations ourselves. We just follow the data, and the data tells us that institutional traders are slightly anxious about global trade policies impacting international travel volumes.
But despite that macroeconomic anxiety, there is recent news keeping retail buyers very engaged.
Oh, the earnings report.
Yes, Booking just released their Q4 2025 earnings report, which showed continued undeniable strength across their platforms. And perhaps more importantly for the everyday investor, there is massive buzz around an upcoming 25-for-1 stock split.
Let's explain why that matters. A 25-for-1 split means if you own one share at $4,250, you suddenly own 25 shares at $170 each.
The pizza gets sliced smaller, but it's the same size pizza.
Right. The actual value of your investment doesn't change by a single penny, but dropping the share price from $4,000 down to under $200 makes it way easier for retail investors to buy in.
Exactly. It doesn't change the underlying math or the market cap of the company at all, but it dramatically increases accessibility and the psychological appeal for a regular person looking to add the stock to their portfolio.
So, bringing this all together, we are looking at two entirely different philosophies for dominating the 2026 travel ecosystem.
It's night and day.
On one hand, you have Airbnb, highly valued, fighting intense, existential regulatory battles in the physical world, but leaning hard into becoming a curated, experience-driven lifestyle brand.
And on the other hand, you have Booking Holdings, a financially undervalued multi-brand logistics machine.
Right.
They aren't trying to be your cool local friend. They're trying to be the inescapable digital infrastructure of your connected trip, quietly processing billions in free cash flow while giving you the illusion of shopping around.
It's a fascinating contrast in how to extract value from our desire to explore the world. Before we leave you today, a very quick reminder that investing in the stock market involves significant risks, including extreme volatility and sudden regulatory changes like we saw with Barcelona overnight.
You never know what a city council will do.
Exactly. Always do your own thorough research before investing your money.
The travel market is particularly sensitive to global events and local legislation, so staying informed on the data is crucial.
It's so true. We started today talking about how travel used to be unfolding a paper map, and now it's driven by algorithmic pricing and options flows. It leaves me with one final thought for you to mull over.
Let's hear it.
If Airbnb successfully monopolizes the curated local experience and Booking Holdings builds an inescapable, frictionless, connected trip-walled garden where every choice is pre-calculated,
Yeah.
what happens to the spontaneous, unplanned traveler in 2026 when every step of your vacation is optimized, algorithmic, and perfectly pre-packaged? Will true accidental travel discovery become a thing of the past?
Something to think about the next time you hit book.
We'll see you on the next deep dive.